Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Gene Goldman, he is the CIO at Cetera Financial Group, joining us here in New York in the Bloomberg Interactive Broker Studio. Nice of you to drop by. Good to see you. Let's talk a little bit about the Fed, because we've got this meeting next week, and today the reading on CPI was a little above forecast. I think from the market's perspective, 50 basis points in terms of a cut next week seems to be off the table, right? 25, is that your sense?
Yeah, definitely. I think today's CPI number, definitely it came in as expected, a little bit higher in core. And that core is so important because that core really cements the fact the Fed does 25 next week. Why the core is so important? Owner's equivalent rent came a little bit higher, but it's more broad-based. So that worries us a little bit about that pickup in inflation. But overall, we think the Fed cuts 25 for each of the next 3 months. We're not headed to a recession. We don't see a recession anytime soon. So we think that 25 makes sense because the payroll report, while it was a little weaker last week, saw some strength. Unemployment rate 4.2%, and we also saw more people coming back into the workforce.
So you definitely heard some people saying, wow, this CPI report was really not what we wanted to see. I think you can actually argue just the opposite, and it seems like the market picked up on this, that a really rapid fall in inflation would further stoke growth concerns. And that has been the bigger concern of late than inflation. So while a little higher inflation isn't great, it does suggest that growth is intact. Thus, let's rally.
Yeah, I think that's a great point. I think that's what helped markets reverse today, because I think the markets and the investors realize the fact that if the Fed does gradual rate cuts, this really says no policy error is around the corner. This is just the Fed looking to prevent a potential recession.
Did it surprise you that leadership was coming from mega cap tech today?
I think not really, because you saw NVIDIA. NVIDIA came out with some really great news in terms of some of their products. Saw that. I do think when the Fed does cut rates next week, you'll see a continued sort of pivot in terms of market breadth widening, especially value, especially small cap. But today's leadership didn't surprise me because technology has been leading all year.
Yeah, this is a big day. But prior to this, if you look back over the past month, you've had utilities up 4.2%, and the Q is only up 1.3%. So it's really quite stark in some ways, and maybe not great news that these ultra defensives have rallied. I
think that's a great point. And some of our favorite sectors right now include industrials, financials, and utilities. Utilities, second quarter earnings growth year over year was up, 19%. Part of it is the fact that AI is helping utilities, and the fact that lower rates benefit utilities by a pretty wide margin.
Are you focused solely on what's happening in the U.S.? Are you looking anywhere offshore right now?
For our clients and our advisors, we look everywhere. We are completely global.
And what are you seeing globally?
Out relative to non-U.S., we're a little bit underweight. We were thinking about boosting our non-U.S. position a little bit later this year, but we do believe that the dollar won't weaken as much as the markets have priced in. We do want to see a weaker dollar significantly in order to go non-U.S. just from currency translation. What we're watching carefully is Japan. Japan's bouncing back in terms of inflation. Europe, valuations are extremely cheap, but what's the driver? Maybe an end to the Russia-Ukraine war. That could be the possibility. Maybe less geopolitical risks. But I think overall, Europe, we're cautious right now. The other area we're cautious overall is energy. Energy, no matter who wins the election, we are worried about energy prices. We think that, let's say if Harris wins, more regulations. We think if Trump wins, there'll be deregulation, but there'll be more drilling. But where are we going to put the oil? We're at record levels of production and record levels of exports. We do think oil is going down no matter who wins.
You talked about drivers and that, for instance, Europe, it's hard to exactly find one. One of the big drivers globally has been AI, and we did have Jensen Huang from NVIDIA talking. He was very, very complimentary of TSMC. He did answer that, they would have options if there was ever an issue. But when you look at AI, the question that Jensen didn't really answer all that well was about whether or not we're seeing return on investment. I mean, obviously for NVIDIA, there's return on investment. They're doing extraordinary numbers. But for those that are buying these chips and trying to make that work, it's still a question mark out there. I mean, what do you see as the answer to that question? Will these gains be monetized?
I think that's an amazing question. This reminds me of the tech bubble. Tech bubble, everything was about the internet. Internet was the future. AI, right now, AI is the future. Fundamentals for AI look amazing. Valuations, I am worried about valuations. So I'm not sure if we'll see a lot of the gains, but survival of the fittest. The better companies will likely win in the AI space.
And we had news today that OpenAI is in talks to raise about $6.5 billion. This funding round would produce a valuation of around $150 billion for the company. Now, we know Microsoft has a big part of that story. When you look at a name like Microsoft, are you interested?
And I apologize for laughing before, but we are diversifiers. We like to be diversified amongst sectors. So there are some opportunities. I really can't talk about individual company names, but we do like technology. We do like some of the cheaper value technology companies. A little bit in sort of a lot of the cybersecurity, a little bit in software, but again, can't really talk about individual company names.
Let's talk a little bit about what could go wrong here, because it feels kind of comfortable at the moment in that you've got the beginning of a Fed rate cutting cycle and the economy seems to be kind of hanging in there. Would you say that a rise in unemployment is the number one issue, or something else like geopolitics?
I think, and this ties into our theme for the next foreseeable future, something that we talked about last time I was on your show. We do think a pullback, an 8 to 10% pullback in the stock market is probable, it's likely, and you can point to a few reasons. I mean, I think you can look at what we call the triple whammy. You have high valuations, high expectations, high concentration in the U.S. stock market. You also have a little bit of disappointment around the Fed only cutting maybe 25 next week. We also have election volatility. Take all this together, September seasonality, and you take the fact that China's growth is slowing. You saw Caixin and the Chinese PMIs last week come in well below expectations. All this together concerns.
So how much cash are you sitting on right now as a percentage of your overall portfolio?
Yeah, we're not market timers. We're not market timing at all. So what we've done is within our portfolios, we've pivoted away from traditional equity exposure. We've reduced some of that much more into liquid alternatives, like multi-manager alternatives. Basically those investments that zig when the rest of the market is zagging. We believe diversification is the most amazing strategy on a go-forward basis for your clients and our advisors.
And when you talk to clients, what are they most concerned about?
I think clients are concerned about the election, and we try to tell our clients, listen, the election, if you look at the last 20 election years, the stock market's up 18 of the last 20 years, averaging about 10.5%. The only down years were 2008, great financial crisis, and then 2000 during Y2K when all the three of us were wearing tinfoil hats and protecting ourselves from Y2K.
So not just the presidential election, what about the makeup in Congress? How do you expect that to shift, and what does it mean for the market?
Yeah, I think our base case today right now is from Congress's standpoint, we do think the Democrats take the House. I think they only need 4 seats. I think with Harris, potentially winning the election, I think with Harris, you probably get 5 seats coming over, 3 from New York, 2 from California. So I do think the Democrats take the House. The Senate is tough because you have Manchin retiring. You have, so West Virginia probably goes Republican. Montana probably goes Republican. This puts the Senate more likely on the Republican side. Either way, whoever wins the presidential election, Harris or Trump, we think you will have gridlock, which, as we all know, means nothing gets done.
Gene, thank you so much for stopping by, joining us for the good conversation we just had with Gene Goldman, CIO of Cetera Financial Group.
Joining us now on the program is Lydia Boussour, senior economist at EY. Lydia, thank you for joining us. The latest data that we've seen in the United States, including the CPI report we just reported on, does that tell a story to you that is a softening economy, but not a collapsing one?
Yeah, so the data this morning on the CPI really showed that the disinflation trend continues. We saw accelerating momentum in headline CPI disinflation. We're looking at headline CPI now at 2.5% year over year. We also saw at the same time some stickiness in services prices, which kept core inflation from moving lower. But overall, I think this report shows that inflation continues to move in the right direction and that there is room for the Fed now to recalibrate policy.
Yeah, a gradual move. I think we could agree with that when it comes to cutting interest rates. There had been a lot of speculation that maybe we would see a 50 basis point cut next week. The market seems to be settling in to the notion that that rate cut, the first, will be 25. Would you agree with that?
Yeah, we're in the camp that a 25 basis point rate cut is more likely. There are some Fed officials, including Fed Chair Powell, that looked to be open to larger rate cuts. But overall, it seems like most Fed officials are more in favor of a gradual approach when it comes to that easing cycle. And when you look at the latest batch of data, the jobs report showed that the labor market is softening, but it's not collapsing. We had, the unemployment rate edging lower. We saw hours worked rebounding. And at the same time, the data this morning also showed that this inflation remain on track, but that there are still some stickiness, that some Fed officials that are perhaps more in favor of a gradual approach will look at and argue for that 25 basis point cut.
I think officials would not admit it, but I think they would see this as a gift, this latest data, because they want to be gradualist in nature. Even when they knew they had made a mistake and they decided to raise interest rates, they went 25 and then 50 and then 475s. So for the Fed, it's probably a lot more comfortable to just do 25. And actually, it seems like looking at the market performance today, they feel pretty comfortable with that as well.
Yeah, I think the key here is really the performance of the economy and what type of labor market softening we're seeing. Today, when you look at broad economic conditions, you look at overall economic data, the U.S. economy is still moving forward at a decent pace. We're looking at growth around 2%, slightly below 2% in the third quarter of the year. The labor market is softening, but there are no signs of broad-based layoffs. So in this environment, I think the Fed is going to remain cautious and go with 25 basis point rate cut in September and a steady pace of decreases heading into 2025.
We were on the air last night with a presidential debate. Do you have a sense of what this election may mean for the American economy under two possible and very different scenarios?
Yeah, I mean, when we look at the election and the post-election landscape, I think there are two key themes that are going to be very important for the outlook. The first one is what happens on the fiscal policy front and the tax policy front in particular, with the expiration of the Tax Cut and Jobs Act. We've run some estimates, and we could see a significant drag if nothing is done. So there's going to be a lot of pressure to do something on the tax policy front. And then on the trade policy front, we have this potential for renewed tariffs and an escalation in tariffs. And so, potentially hurting the economy and also leading to a renewed inflationary impulse. So there is a lot of uncertainty on the policy front. And that's also one more reason why the Fed needs to create some room here and lower interest rates to be in a better position to address these risks.
It does seem like we might see a little bit of a battle between monetary and fiscal policy in the next year. Because, if you think about it, you could almost imagine a scenario where the Fed is cutting interest rates, but the spending is just so dramatic that yields start to edge higher. And I wonder what sort of story that tells investors.
Yeah, there's going to be an interesting interplay between monetary policy and fiscal policy. Our base case is that the Federal Reserve will lower interest rates by 75 basis points this year, and will lower interest rates by another 150 basis points next year. But that's under the assumption that the economy continues to gradually cool. We see below trend growth heading into 2025, and that's also under the assumption that inflation gradually reverts back towards that 2% target, and that the labor market also continues to rebalance in an orderly manner.
If memory serves, I think the latest Atlanta Fed GDP Now forecast was around 2% growth. Is that pretty much the way you see the American economy expanding right now, 2% annualized?
I mean, looking at the latest data, we also have our tracker right now at around 1.8%. Consumer spending is shaping up to be quite solid in the third quarter because we have great momentum heading into the third quarter. But when you look at the overall picture, what we are seeing is consumer and businesses becoming more discerning with their spending decisions because we're still in an economy where policy is quite restrictive. We still have interest rates above 5%, and it's going to take some time to go back to a neutral stance. So that's really the reason why I think below trend growth is the base case scenario, at least for the next few quarters.
So, Lydia, where do you actually see the neutral rate at the moment?
So we have the neutral rate, slightly below 3%. So we expect interest rates to move gradually lower. There is a wide range of estimates around the neutral rate, as you know. But I think what's really clear today is that we're still way above that. And so there is always this risk that, it will take too much time to get there and that we're still going to see a lot of downward pressure on the economy.
Well, if you look at the bond market right now, it's amazing because the spread between the 2 and the 10-year is less than a full basis point. We essentially have a flat yield curve right now. When you look at that and what the market is beginning to expect, how do you understand it?
Well, we're today in this environment where the Fed is going to get this easing cycle going. There is a lot of rate cuts currently priced in by the market. And we think that the Fed is likely to deliver on some of these rate cuts because they are attuned to this risk that the labor market softening could turn into something more significant. And because they also now are acknowledging the fact that the upside risk to the inflation outlook have been receding. So if you put all of this together, you have an outlook where the Fed is likely to be moving interest rates, on this, is going to stay on this easing cycle until it gets to that neutral rate, which we think will happen by the end of 2025, early 2026.
So for at the moment, is the U.S. economy the sort of shining light at the top of the hill or no?
Well, if you look at some of the data you're getting out of Europe and Asia, we're still seeing a lot of resilience in the U.S. economy. But what we're likely to see going forward is a softening in economic conditions.
Yeah, it's a really interesting point. Lydia, thank you so much for joining us. Lydia Boussour, senior economist at EY. Well, a Bank of Japan board member says the BOJ will adjust policy provided the economy performs in line with projections. We welcome Paul Jackson to the airwaves, Bloomberg economy editor, to take a closer look at what we might expect. Paul, BOJ officials seem a little nervous here about the volatility that was caused by the rate hike in July. So let me go out on a limb and say not likely they will make a move this month.
I think you're right there. I think it's a time to wait and watch, given the extreme volatility we saw after that July rate hike. Remember, this is only the second time the Bank of Japan has raised rates in the last 17 years. So we saw very sharp volatility afterwards. The Nikkei stock index had its biggest drop on record following the rate hike. Of course, one of the key factors was also U.S. data, which fed into the narrative for the Federal Reserve and rate cuts. So it wasn't just the BOJ rate hike that caused that volatility, but still, I think there's enough reason there for the central bank in Japan to want to just wait and see, look at market stability, and also to look at the impact of that second rate hike in July. So I think the widely held consensus for next week is there's going to be no move from the Bank of Japan, but that does not mean rate hikes aren't in the pipeline coming ahead.
Yeah, enormous volatility with the unwinding of that yen carry trade as well, which then brings to my mind the concern that the BOJ may have when it watches the currency perform in markets. Is there a kind of a comfort zone that the BOJ has, do you think, for the yen vis-a-vis the dollar?
Well, that's a very interesting question. Of course, the BOJ would argue that it is not targeting any currency levels. But let's face it, the yen has been extremely weak against the dollar. And while that really helps its global companies, its companies with a lot of exports, it inflates the earnings for those companies. For domestic operations, it's the opposite. It raises all the costs, puts pressure on them, and it also makes the power of the yen for the average Japanese consumer, especially for thinking of going abroad, much weaker. So in terms of levels, I'd say 160 is definitely too weak. We see a lot of talk about the yen getting too strong when it's between 100, 110. So we're a long way off that. But sure, the narrative is going to change towards is the yen strengthening too much. We get past 120, I would say.
It's hard to argue with the math at the moment. It looks like U.S. rates are heading down, that Japanese rates are heading up. And when you put that all together, it would seem to augur for a stronger yen. The pace is what matters, I suppose, the most. The pace was just too abrupt when we had the July rate hike. So some modulation there, but the yen will get stronger from here, right?
I think the yen is going to get stronger, but I think we should be wary of thinking that the Bank of Japan has seen that volatility and is now scared off hiking again. I think they've been very consistent in the messaging that no, if forecasts are met as we hope, then we are going to continue hiking. Now, is it going to be every quarter? No, I don't think so. But I think the consensus is that December or January is probably the timing for the next rate hike. And don't forget, we had a story in the last few days with people familiar, and their views that BOJ officials see this idea that a nominal interest rate of about 1% is probably around the minimum level for the neutral rate. So if you think of it in those terms, that's 0.75% rate hikes that could be in the pipeline.
Paul, take a step back. Help us understand the macro view of the Japanese economy right now. Economic growth and inflation. How are they performing?
Well, the economy has been sputtering. We've been lacking consumption in real terms, and that's really down to inflation. Don't forget, Japan has not been used to inflation. It's had decades of deflation. The goal in Japan has been to create inflation, not crush it. So the optics are very different in Japan. Inflation at the moment overall is 2.8%, and that's been really weighing on consumer spending. So really, we're looking to see if the economy is kind of engaging gears and is now moving towards growth with a positive inflation cycle that allows more rate hikes.
Well, and wage data is very important. How have wages been moving?
Well, I think we're seeing some encouraging signs in the wage data picking up, and that hopefully should feed in to stronger consumer spending over the coming quarters. Don't forget, we've got another key factor that's going to weigh in on the BOJ's calculus, and that is we've got a leadership election for the country at the moment taking place, and there's a strong possibility also of a Japanese general election this fall. So there's another reason why maybe the BOJ would wait until the end of the year or early next year.
Paul, you were talking a moment ago about the extent to which a weak currency benefits Japanese exporters. How is Japan Inc. performing these days?
Well, I think we go back to that point that those companies with the presence abroad, overseas, they've got this big currency inflation factor that bumps up their earnings. So they're doing well. I mean, they've got record profits. Of course, they will be tempered as the yen gains strength. So I think it's really a case of will the currency get back to a kind of sweeter spot that balances the growth of the firms with a global presence and the firms that are more domestically focused.
Paul, thank you. Paul Jackson, Bloomberg Economy Editor.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.